does having a parental guarantee increase your lending capacity? Hey guys, Justin Picker. Got a really good question that's come in about parental guarantees. The answer is no, it does not, but technically it somewhat does. So the first part is no, it doesn't increase your lending capacity unless your parents were, say, going to be a co-borrower with you, which ultimately you don't really want to be doing if you're looking to get, be a first home buyer with stamp duty concessions and stuff like that. And also for building your own portfolio. So once you kind of get your parents involved, they're also liable for that debt if you're using both incomes. When we're using a parental guarantee, we're just using your parents' property as a security. So if you're going to buy a property for $600,000, we need obviously a guarantee of 20%, which is going to be $120,000. Same if you're going to buy an investment property for $300,000, we need a guarantee of 20%, which would be $60K. And that goes against your parents' property, whether that be their owner occupied or for an investor. The actual whole loan is still funded under your name. So if you're buying it for $600, you're getting the guarantee, the loan is for $600 under your name. Same for investment. If it's a $300 purchase, it's a $300,000 loan that's solely under your name. So you need to be able to service that. And if you are a bit short, then we might have to go back to the drawing board and see what we can do. Where it does slightly improve is that when you do get a parental guarantee, when the interest rates actually become a little bit cheaper as if you were doing a 20% deposit. So if we're looking at doing this as a 10% deposit, and let's say the interest rate is 8% on a 10% deposit, but if we had the parental guarantee, the loan might be, say, 6.64% as an example. So you got a bit over a 1% different because that risk change. When the bank assesses you, they're not assessing you at 8%, it'll be like 6.64%, which technically would increase your borrowing capacity because the risk has changed because you've got the guarantee. That might help if a deal is really tight and you can get it, but it does really depend, again, on your circumstances, the type of property, etc. In summary, no. If you're thinking you're going to use mum and dad's property plus their income, no, unless you're getting them both going on the loan together. But if you are getting them to come on, it does slightly increase that lending capacity because obviously you're getting put down in a lower grade of risk, which will obviously reduce your interest rate and allow the banks to give you just a tad more money. It's not a great deal, but it is a little bit more, where it's really tight, could get you across the line. Parental guarantees, if you can get a hold of them, great. If you need your parents to get on board and you want to have a chat with us, go through the ins and outs, please reach out to us. It is like the eighth wonder of the world, especially if you're looking to get started. So definitely look to use the parental guarantees if you've got them on offer. And if you need a hand, please reach out to us. Hopefully we can work with you soon. Cheers.